The Central Bank of Kenya today has decided to leave the interest rate unchanged at 6.25%. The decision comes amid great unease at the central bank's management of Kenya's interest rate strategy and inflation in general.
Kenya's inflation accelerated to 14.5% in June, up from 4.5% in January this year, fanned by higher food and fuel prices and a national drought. Today's MPC decision in Kenya will be keenly watched after what some analysts have seen as inconsistent policy making from the central bank. Since the start of the year, the bank dropped rates, only to increase them last month. The pressure to increase rates comes at a time when the central bank is also battling to boost growth in a country recently wrecked by protests over soaring food prices. Currently, base lending rates have climbed to more than 15% as the era of the high interest rates return to the fore.
I think it's actually highly unlikely that the banks would reduce the rates. I mean, the cost of funds has shot up dramatically, and CBK is being quite unrealistic in telling banks to lower the rate when they're borrowing from the overnight window at levels of about 6.25%, and that's very difficult. Actually, they've made it even tighter. Liquidity is very tight, so I mean, it's very unrealistic. What we actually might see is, I think the president had spoken about it about a month ago, where they might actually create a reference rate that banks can peg their lending rates against, and this will be regulated by the central bank. This, I think, at the moment, if they wanted to lower it, this would be the way to go. But as for I'm using monetary policy to do this, I think it's very difficult in the current environment we're in.
Analysts, however, say the central bank has not done enough to prevent a sharp drop in the value of the local currency, which plummeted to record lows in June. This has further raised concerns that the economic growth of 5.6% recorded in 2010 might not be repeated this year.